Alright, today is Tuesday, August 25th, and this is a post-market review for the market's activities today. Here is the agenda for today, and here we go. The Dow Industrial Average closing in the red, a decline of 60.02 points or 0.21%. What about the Nasdaq? Closing in the green, 86.75 points or 0.76%, and the S&P 500 closing in the green, 12.34 points or 0.36%. And switching to the sector's performance, the gold medal goes to communication services, aka Facebook, and the silver to consumer cyclicals, aka Amazon, and the bronze goes to healthcare. The laggards are utilities, of course, because we saw yields climbing up in the morning, and materials, and of course, industrials, or rather energy. We saw crude prices climbing today, but of course the Exxon getting the boot out of the Dow, that impacted the entire energy sector's performance. And speaking of energy, let's switch to the futures market. Crude and energy in general did very well. We're talking about the futures here. Lumber took a break yesterday and now resuming the march to the green skies. What about coca? Coca continues the march to the green skies as well. And look at coffee. I was looking at coffee, the chart of coffee yesterday, and thinking about opening a contract for September. And what do you know? Coffee is rallying today. I missed it, but we'll see if coffee will continue its march. And of course, we have lean hogs. I closed my lean hogs position. If you remember, I called the bottom on lean hogs and I bought a contract there, but I'm closing my position in lean hogs, taking profit. So for now, I don't have any futures positions, but I'm thinking about opening some in coffee and oats. As you can see, oats had a very good day today, and it looks like it's bottoming and it's ready to climb higher. What about corn? Remember, corn had a big move a few days ago and it's still continuing the impulsive move to the upside due to a shortage of corn in the country. And the decliners, of course, OJ. Yesterday I told you I closed my position in OJ and now OJ is declining, taking a break. We'll see what OJ will do in the days to come, but it's likely to settle down at these levels for a while. And now, switching to the big casino, the options market. Let's see what the gamblers are doing. Number one, NEO. Check out the volume here. Big volume. And the calls, 84% of the total options traded today in NEO. NEO is one of the Chinese EV competitors of Tesla. And it's been, as of late, eating Tesla's lunch in China. Of course, Elon is dancing and he thinks that the Chinese are his friend, but the Chinese, of course, invited him to the country so they can steal his technology and his talent, pass it on Chinese EV makers, and then squeeze him out of the market and give him the boot. And you see the performance of Chinese EV makers being very, very impressive as of late. In the second place, Apple. You see Apple, however, the options volume is cooling off compared to Monday and Friday. We're post-split board now. The record date, the deadline was yesterday, and now you're in purgatory between, of course, the record date and the execution of the split. 68.6% of the calls or the options traded today in Apple were calls. And Facebook, of course, continues to ride high. They're doing new deals, and of course, the Instagram feature of Reels, the TikTok competitor, and the options traders here betting on further upside. The stock had a massive movement as of recent, but the bet here, 74% of the options traded today are calls. Let's talk about a few notable names here. What about Salesforce? Salesforce, of course, being included in the Dow now. And I released this tweet in the morning saying that we're going to buy options or call options on Salesforce today because the Robin Hoodiots, of course, going to chase the name regardless. It's being included in the Dow. It doesn't matter if this is good or bad. They don't know. They don't care. They're just going to chase the name. So we play the psychology and we make money of these useful idiots. And what do you know? 63% of the options traded today were calls. And I personally bought the 120 expiring this week. I did not expect the massive move after market, of course. I was hoping that I can close it tomorrow at a profit from time value alone. However, the stock last time I checked Of course, I bought at the 220, not the 120. The stock is at 220, more than 220 now. It's actually trading at 240 last time I checked. So this trade has about $2,000 per contract as of right now, and the profit is massive. So again, thank you to the Robinhood idiots who gave us this. It was a trade from the skies today. It was very easy, very obvious to follow. And of course, American Airlines, as soon as the news hit that American Airlines is furloughing over 19,000 workers, we'll talk about that in a little bit in the headlines. But you saw the stock taking a dive, and we have, of course, gamblers invading the market, and the mentality goes as the following. Anything that drops big will have to rebound big. Any dip is worth buying. So, of course, they bought and rushed, and you saw the call volume. I was watching live as it happened, and I saw the call volume surging significantly after the drop. American Airlines still closed in the red. It did not bounce back from the drop. So this rationale is not healthy of, hey, let's just buy anything that drops. Every dip is worth buying. It doesn't work that way. You gotta be careful here. And now, switching to the headlines that shaped the day. And the first headline, of course, came yesterday from the Dow Jones Industrial Average, saying that we're giving Pfizer, ExxonMobil, and Raytheon, aka United Technology, we're giving them the boot out. They've been underperforming. Goodbye. I thought, of course, they're going to give Walgreens the boot, but they kept that garbage name in the Dow. And they included CRM, Salesforce, Amgen, and Honeywell. All of these three names performed very well today in the green significantly due to the excitement of including them in the Dow. Of course, when you look at history, with few exceptions, every name that was included to the Dow is called the graveyard for stocks. Stocks go to retire in the Dow. They become boring and they become yield names and they don't grow as much. Few exceptions, of course, are the recent moves in Apple and Microsoft. But other than that, the Dow is very boring. So don't expect Salesforce, Amgen, Honeywell to be high-flying stocks in the future. They will be boring Dow stocks. And of course, Pfizer, Exxon, Raytheon, they took it in the chin today, closing in the red, selling off. Maybe they should be thankful that they're taking the exit door from the Dow. And of course, a reminder that the Dow is a priced-weighted index, not an equal weight index. So the stocks with the highest price control the direction of the Dow. We know that Apple is splitting and it's going to be a smaller stock now. So its weighting in the Dow will be less impactful. And this is a move, of course, to shuffle the weighting of the Dow. And of course, early in the day, we had very bad news. Consumer Confidence Index, 84.8 versus 91.7 last month. Consumer confidence is dwindling. There isn't unemployment benefits like before. The stimulus is already gone. Now what? You think consumers are confident that they can go and spend like drunken sailors? The credit card debt are racking up. A lot of them are losing income, or the incomes has been slashed. They don't have unemployment benefits anymore. The stimulus is gone. You see that the consumer weakening in the economy is not good. You can pump the stock market all you want and tell me that company X and company Y have a positive outlook. There is no positive outlook without a strong consumer out there. And building on that narrative, check this out. Delta firing or furloughing 2,000 pilots. That news came yesterday after the market. This is horrible. Just there's no way to look, two ways to look at it. This is negative and it's disastrous for the economy. I don't know if Delta has any pilots left. I mean, I've been hearing about pilots being furloughed and taking early retirement. And now, of course, we have the news from American Airlines today that they are going to furlough 30% or 19,000 employees out of the workforce. Remember, the government gave the airlines bailouts, and the conditions were to keep employers, or employees rather, employed until October at least. That clause is coming to an end. And now airline companies can keep the bailout money and fire the workers, cutting costs. And of course, maybe they're going to give some executives bonuses. That will be met with extreme outrage. So I don't think they're going to go there. But they're trying to reduce their costs and they're firing an enormous amount of workers. Dwindling consumer confidence, dwindling consumer power, more unemployment. This is not a good picture for the economy overall. Please try to convince me with a straight face that we are having a V-shaped recovery. I'll smack you in the mouth right there. And what about the TikTok saga? Netflix now, TikTok is actually asking Netflix to jump to throw their hat in the ring and try and buy TikTok. Maybe TikTok see that the competition is favorable. They're going to have a huge valuation. If you have Microsoft, Oracle, and now Netflix butting heads on who's going to buy TikTok. Netflix, of course, doesn't have the disposable income that Oracle or Microsoft have. So perhaps there's a different strategy here from TikTok executives favoring Netflix for the takeover. And of course, we have the 2 years note auction today, and it was a very good, a blowout auction. You see that the demand for lower term treasuries is high, but the demand for high or longer term treasuries and bonds, not so much. We saw the 30-year bond auction a few weeks ago bombing, but we saw the 3-year note and now the 2-year note outperforming. What does that tell you? It tells you that investors believe that shorter end yields are in high demand and they have to stampede and lock in the yield that they have right now because yields will trend lower in the shorter end of the yield curve. However, in the longer end of the year or the yield curve, yields can trend higher because the risk is higher. It's a longer term. Investors are looking for higher yield as security for their investment. Now, a lot of zombie economists like to make a conclusion that this is a signal of underconfidence in the United States economy in the shorter term, but overconfidence in the long term. That is garbage. It means nothing. Take the information as it is. The results are telling you that the shorter end is in high demand. They want to lock in. There's a rush to safety in the long term, in the short term. In the long term, they want more assurance or more yield to take the risk. That is it. That is how I read the information. And that would cause further steepening in the curve. And the likelihood is if we do dip into negative rate territory in the treasuries, it will be the shorter end of the yield curve diving first. Now, a lot of traders ask me how to read the results from the treasury auction. Here is the important information that you need to pay attention to. The first bit of information, of course, are the results of the auction, and the high yield is the highest yield allocated in this auction, meaning that everything below this yield in the bids, if you bid any amount of yield lower than this high yield, your bid will be accepted. If you bid higher, your bid will be rejected. And of course, the loaded at high speaks for itself. It tells you the percentage of the bids that were accepted at this high yield in the auction. And of course, you have the median yield. The median yield is the yield where 50% of all bids accepted were below that yield. Of course, when you bid in a treasury auction, it is different than the regular auction. When you go to a regular auction and you're bidding on a frame or a piece of jewelry, the bidding process is very different. You bid on the higher price. I have 100. Can I hear 120? Can I hear 150? Can I hear 200? It doesn't work that way in the treasuries. In the treasuries, they bid on the lower yield. At the end of the auction, they're averaged out all the bids and a high yield is determined, and anything below that high yield is accepted. And here is the bids, the tendered. You see the tendered column right there, and you have the competitive. These are the people who are bidding on the yield. They're bidding lower and competing on driving the yield into a certain point. The non-competitive are the kind of bids that say, hey, we'll accept whatever the results are. Whatever yield it is, we'll accept it. So the competitive bids, it's what really matters here. Tendered means the bids, and accepted, of course, is the percentage or the bids that were accepted at the end of the auction. And you have the SOMA, the open market, that is the Fed bidding on the yields. But perhaps the most important number or the most important ratio here, the traditional way of evaluating a treasury auction. There are so many ways. It can get really complicated, and there are a lot of professional people who go and dissect each auction and give it a grade. But for retail traders, for simplicity, the traditional way to evaluate a treasury auction is the bid to cover ratio, comparing the percentage of the bids versus the percentage of the bids accepted. And in this auction, we had 2.78, and that bid to cover ratio is higher than the average. If you average out the last few auctions for the 2-year note, this bid to cover ratio for this auction that we had today is higher than the average. That tells you that the auction went very well. And now, let's check on the mania, the market mania, what's going on in the bubble. Here's a slide that I made in the morning, I released to my Twitter account, comparing Apple's market cap of 2.15 trillion bucks right now to the nominal GDP of certain countries. And you can see that Apple market cap is bigger than the entire GDP of the country of Italy, Brazil, Canada, Russia, South Korea, Spain, Australia, Mexico, Netherlands. This is the insanity. One company is bigger than entire countries. Someday you will look back at this slide and you will remember the craziness of the mania of 2020. Now switching to the heat map analysis, and you can see right away that the breadth of the market is getting a little better. However, not as we like to see. Not yet, at least. You can see Microsoft, the big boxes of Microsoft, Google, Facebook, Amazon, Baba. Apple, of course, did not do much today, but these big boxes is what driving the market to the upside. And of course, we saw participation from the inclusion of certain names in the Dow. Check out CRM, Salesforce, Amgen, Honeywell, all doing very well today. And of course, switching to the rotation, let's check out what's going on with the vaccine rotation. Yesterday, we saw the comeback stocks outperforming big. Today, we're seeing a muted picture in the comeback stocks, and the formerly known as momentum stocks, now known as the garbage stocks, outperform just by a little bit. We're again playing the yo-yo game, back and forth, back and forth. The problem is when you see a day like Monday where the names in the laggards are up big, some up 3%, 4%, some up 10% in the airline sector yesterday. This is not healthy. What happens is you're going to see a sell-off the next day. We don't want to see that. For this rotation to be sustainable and healthy, we need to see consistent outperformance from the comeback stocks by the tune of 0.5% or so every day. That is the healthy way for rotation to happen. When you see the days of 10%, 8% in certain names, that is not healthy and not sustainable. We'll keep tracking the rotation. And of course, right now, remember, retail traders control the narrative in the market during the summer solstice or whatever you want to call it. But after Labor Day, professional traders will come back to the market. Some of them are already coming back, and they will decide the fate of the market. They will decide which sector, which direction they want to take the market to. So expect the yo-yo game to go on for a little bit, but then we will have a decisive decision perhaps after Labor Day. And moving on to the charts analysis, and starting with the chart of the SPY, the S&P 500. From a 15 minutes perspective, here is the action of the day. We started declining right away, catching a rebound from this level right here, and then rebounding again before making the swoosh formation on a very low volume. If you've been following me for a while, you know what this means. This is not a good formation, and it usually precedes a big correction or a pullback. Now, keep in mind that we're talking about a 15 minutes perspective. So we're not talking about the end of the SPY or the crash. We're talking about a pullback from a 15 minutes perspective. And therefore, of course, I bought some puts at the close for the SPY 500, and these puts are expiring this week. I know it is blasphemy to buy puts. Oh my God, you buying puts? What's going on with you? But we're doing a day trade here for a pullback from 15 minutes perspective from these levels where we closed at. Remember, Powell was speaking on Thursday. Tomorrow is not a surprise that the market could pull back a little bit from a 15 minutes perspective. So we're expecting a pullback perhaps to these levels or even lower, and then rebounding. However, I am betting that this formation of the decline, the double bottom, and then the swoosh will conclude in a pullback from a 15 minutes perspective. Now, switching to the daily performance of the SPY or the daily chart, let's take a look. Of course, when we get closer here, we did not make this tail right here. We didn't touch back the support line. I don't know if your charting program is showing the same thing, but this is wrong. We just gapped 2 days in a row. There is no tail catching the support. So it is only reasonable that we can pull back a little bit here and catch the support line. This is what I'm betting on from buying the puts at the close today. Small decline to the support line, and then we'll take it from there. And switching to the triple Q, 15 minutes perspective, it's the same thing for 2 days in a row now. The Q's doing the same thing, the double bottom and the swoosh. which will conclude, it could go higher a little longer, but will conclude in a pullback. And we'll see, of course, the levels about right here. Maybe we'll catch support and take it from there. The pullback in the Qs, because this is a 2 days formation versus 1 day formation, the SPY, it could be a little steeper in the Qs. And now switching to a daily chart of Facebook. And when you take a look at the daily chart of Facebook, you can see the trading channel right here. We've peaked twice and took a dive from the higher end of the channel. And of course, here, let's mark these right here. This is the first decline from the channel. Second one came very close. And we have a recent one right here. And lastly, for today's activities. And of course, we caught support on the lower end before. We broke it. This was a big correction. But again, it acted as support multiple times. This was the exception. And of course, the divergence from the channel, and it was corrected right away. Now, let's switch to the 15 minutes perspective and see what's going on with Facebook chart. As you can see, the pullback from the higher end of the channel, and again today, and of course, the natural conclusion is we need to break it, gather a little support here, and break the upper channel, perhaps tomorrow. But if we don't do that, then don't be surprised if Facebook starts to decline all the way to the lower end of the channel. It will take, of course, longer than just a day or two to do that. But the risk versus reward for any disciplined trader, if you caught the move from the lower end of the channel and you've reached the top and you sold and you bought again, and now is the time to sell and you take your profits and anticipate a pullback in Facebook stock. And moving on to the TNX chart from a daily perspective, we're talking about the 10-year note yield here. Remember the bull flag formation, and now you have the breakthrough from the bull flag to the upside. However, because of the 2-year note yield that we saw today, the 10-year reversed. And of course, we can't make a lot of conclusions here. Looking at the move itself from a candle perspective, it is negative, and it's probably a pullback that will continue for a few days. We will see if the bull flag will continue as the following. Here's the bull flag, the pop out, consolidation for a little bit, or pull back for a little bit, and then moving to the upside again. It could be because breaking out of the bull flag formation for a few days, to just have that breakout for 1 day is pretty lame and it doesn't make sense. You need it to continue for a little more. I would be very surprised if we just go back and decline further. Because remember, it was a 2-year note. It was not for the 10-year. I understand they all act and react in a similar way, but the 10-year is at the lower or higher end of the yield curve, and there are very different factors controlling its yield compared to shorter term notes. And now let's conclude the video. Tomorrow we have durable goods, and durable goods are probably not going to move the market by much, but we do have bad formations in both the SPY and the Qs being overextended, and from a 15 minutes perspective. So I'm expecting a little bit of a pullback in the indices tomorrow, and perhaps in anticipation of the Yellowstone/Jackson Hole speech of Jerome Powell. The market will be a little bit nervous tomorrow in anticipation of the speech. Of course, whatever he's going to say in the speech will impact the market on Thursday and then Friday. So don't forget about that. But here's the picture so far from this week. We have consumer confidence being destroyed completely. This is very bad. With the number that we got today is very negative and dark for the long-term look of the economy, at least for the rest of the year. And now we have, even within companies, not just people and employees, we have it with corporations. The haves and the have-nots. You've seen the have-nots in the case of airlines, Delta, American, and soon enough we're going to hear with United and other names furloughing thousands and thousands of workers. They can't keep them on the payroll anymore. Meanwhile, you would expect the haves to increase employment. This is the way that the neo-capitalists and those defenders of the big tech corporations been telling us for a while. Yes, Amazon is eating small business and destroying small business. But whatever jobs lost in the small and medium business sector are being compensated with job offering from big and large firms like the technology companies and Amazon, etc. But when you look at the real data, the haves of the corporations, the beneficiaries of the pandemic lockdown, are not really hiring. You saw Amazon actually hired temporarily, and now they gave those employees the boot. Technology companies are not hiring to the tune that we expect them to. Some of them are actually cutting jobs because they figured out that with the work at home environment, it can be more efficient and they don't need as many employees. What does that tell you? We're going to have higher unemployment, persistent higher unemployment for a very long term. The way the market is moving right now, it is expecting a recovery, a very fast recovery to happen soon. The longer this recovery takes, and the longer we kick the ball further, market participants, and we're talking about rational market participants, we're not talking about the gamblers who invaded the market this summer. We're talking about rational market participants. They will realize the disconnect, and you'll see the market following suit with what's going on in the economy. Of course, we have a job report for August. Expect that job report to surprise in the upside somewhat, not in all sectors. I know it's early to make predictions for the job report this month, but you and me know we've been going out and we know what's going on. Restaurants, bars are packed. They have outdoor seatings and they're packed, and you see the rehiring of waiters and cooks and bartenders picking up across the country. So you could see on the surface, a very good upside surprise in the August jobs report. But as we go to the winter month, and if the virus continues to persist and there is no vaccine, this whole outdoor seating thing and the pickup or uptick in business in the leisure sector, that will die off, specifically in the northern side of the country, and you'll see unemployment picking up again. So you have to keep that in mind. We're still not out of the hole, not even close. And as a trader, you have to be aware of what's going on in the macro and micro environment around you and be disciplined in your trade. Do not be seduced by the impulsive moves of the market and chasing it. You will feel really good for a few days, perhaps weeks, but then when you get flushed down, it's not going to feel good. Wasted 3-4 months building gains, and now you lost them all in a couple of days. This is not an environment any disciplined trader can get behind. And I argued a few days ago that what you can do as a professional trader and as a disciplined trader is stop trading, reduce your trading, sit back, grab a big bag of popcorn and watch the show. Whatever is happening in the economy right now, the negative picture will catch up with the market. It always does. And don't expect the Fed to continue to hold the market and use the Fed as an excuse for the impulsive moves in the market. The move that we are in right now has gone far beyond whatever the Fed has offered for the economy, and the Fed has its limitations too. Remember, liquidity, loans do not substitute for lost revenue. They only add to your balance sheet in terms of debt, and there's a threshold where that becomes a negative liability on any given company. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.